problem with putting together a presentation ahead of this panel is that most of the points that I wanted to make have already been made by the panelists, but I'll try to skip over those and try to offer some answers. Firstly, Mr. Helvig asked, what is the bank sovereign nexus? Well, there's two sides to it. One of it on the asset side of a bank is Homebuyers. The other on the liability side, what I call home arrest, is what happens to depositors in the Eurozone who have no choice but to use their home banks. Let's take a look at Homebuyers. This is from 2012 in the Euro area. Homebuyers broadly defined as what percentage of your sovereign exposure as a bank is to your home sovereign. Now, before the euro, this was not a problem because that was the risk-free asset. With the euro, there are many risk-free or sovereign assets you can put your money into. They don't have to be those of your home sovereign, but you see that banks like the Greek banks don't have Italian bonds on their books, don't have Spanish bonds on their books. They just have Greek bonds on their books. And the problem that this creates is that a Eurozone financial system, which is meant to be an integral thing, can break down and can behave in very different ways. This is the work of academics, an ECB working paper. It shows you how homebuyers behaved in vulnerable countries on the right, countries like Greece, and less vulnerable countries on the left. When the countries were stressed, domestic banks stepped in and lent the governments more money. Why is that? There's a very interesting working paper from the Nederlandse Bank, the Dutch central bank. They've done some very fancy maths, and they tell you that the answer is moral suasion, meaning it's not prudent risk management by the bank treasurer that leads to these decisions. Instead, it is a phone call from the finance minister of the home authority. We need money, and you need to show up at the bond auction. You don't really need fancy maths to prove that. Let's take a look at Greece. There's two Guardian headlines, one from the 4th of March, 6 weeks before the first bailout. Somehow Greece printed 10-year bonds that were oversubscribed, 2x, 6 weeks before the country applied for a bailout. From a risk management perspective, that's insane. Who would go and buy those bonds? And we saw it was insane. And as Mr. Provopoulos referred to, the PSI, that had a very big, that caused very big damage on those people who made that decision to go in there. Who pays for that? Shareholders pay for that. This is a comparison. This is the cost of home buyers. Sorry, it's quite bright, so you can't see it, but if you see it, you'll see that BNP Paribas, which is the orange line, is about 70% of its value after dilutions and dividends in the past 10 years, whereas the National Bank of Greece, a shareholder back in 2007 after dilutions and dividends, is at 1% of 1% of the original value of the stock. And there's someone else who pays for that, and that's the real economy. This is a familiar chart. This is Greek loans to non-financial corporates. Weak balance sheets brought down by a weak state cost the real economy growth and leverage, and we're seeing this every day. Very briefly, have we made any progress on all this situation with home bias and having, as Professor Belka put it, supranational authorities but national commercial banks? In theory, we have, yes. There is an institutional framework in the Eurozone. We have international regulators, we have international bond markets, but in practice, it doesn't seem like much progress has been made, and I'll put this in the starkest term possible. I put it to you that Greece is the North Korea of the Eurozone financial system, with some exceptions. If you're a super corporate and you can raise funds in Luxembourg or Guernsey, then no, you have perfect access to the European financial system, even from Greece. But if you're an SME, or God forbid you're a depositor, and that's the people in the top left in the times of capital controls, you do not have any access to the Eurozone financial system. You are cordoned off from all that, and the regulatory authorities make sure that remains the case. Two examples at the bottom. One is a headline I picked up from a Greek newspaper about a Kikloma, which is a criminal organization. What were these criminals doing? They were using point-of-sale systems, so the thing where you swipe the credit card, from Bulgaria, an EU member state. This is last year. Apparently that was a crime. And the second is, tried to do this myself after Brexit, tried to open an account in Germany with DKB Bank. If you try and do that online, if you're in Germany, it takes 30 seconds. If you're outside of Germany, it just doesn't work. That makes no sense in a banking union. Is there any hope? And when I say Greece here, I mean the Greece economic actor. Yes, there is hope, and I'll finish with a suggestion by Jens Weidmann. Before Germany gives in on deposit insurance schemes, the regulator should impose a maximum limit on sovereign holdings by domestic banks. Thank you very much.